A scoring method becomes the single gateway to credit. Millions of people wait outside a system that cannot see them. The gate looks small. The cost is not. Before the score exists, lenders make decisions manually. Each branch uses its own method. Loan approval takes weeks and outcomes vary widely across regions. Lenders face rising loan volumes. Manual review cannot keep pace. The pressure to process more applications faster becomes a structural problem demanding a solution. A statistical model is proposed. It converts credit history into a single number. That number can be computed in seconds, regardless of who the applicant is. The model is built on historical repayment behavior. It assumes that past credit use predicts future reliability. This assumption is reasonable, but it contains a hidden boundary. To build a score, the model requires a credit history. But a credit history can only be built by first accessing credit. The loop has no external entry point. The model is adopted by one major lender. Approval speed improves. Costs drop. Other lenders observe the efficiency gain and begin adopting the same model. Adoption creates network effects. Lenders who do not use the model fall outside the comparison standard. The model is no longer optional. It is the baseline. The scoring model is trained on data from existing borrowers. People outside the formal credit system are not in the training data. The model learns nothing about them. Regulators review the model for fairness. The model does not use race or income as inputs. It is technically neutral. Approval is granted and adoption continues. Technical neutrality and practical neutrality are not the same. A model blind to race can still encode its effects through proxies. Credit history is one such proxy. Redlining had previously denied mortgage access to entire neighborhoods. Those neighborhoods built less intergenerational wealth. Less wealth meant less credit history decades later. The credit score does not cause the historical gap. It simply measures a gap that already exists. But measuring it as a neutral number gives the gap institutional permanence. Congress passes the Fair Credit Reporting Act years earlier. It regulates how credit data is stored and shared. It does not regulate which factors a scoring model may weight. The scoring model weights payment history most heavily. A single missed payment lowers a score significantly. Recovery requires years of consistent positive history to offset it. Score recovery is asymmetric. Positive events add small increments. Negative events subtract large amounts. The model penalizes disruption more than it rewards consistency over time. The model also considers credit utilization. High utilization lowers scores even when payments are made on time. This penalizes persons with lower absolute income regardless of repayment behavior. Lenders begin linking score thresholds to loan terms. Below a threshold, interest rates rise. Below a second threshold, the application is rejected automatically without human review. Higher interest rates for lower scores mean higher monthly payments. Higher payments increase the likelihood of a missed payment. The score drops further. The cycle reinforces itself. This feedback loop was not designed. It was not intended. It emerged from the combination of score thresholds and risk-based pricing when both policies were applied simultaneously. By the mid-1990s, the model is embedded across mortgage lending, auto loans, and insurance. Each sector applies its own thresholds. The score becomes a universal filter across economic life. Fannie Mae and Freddie Mac formally adopt the score in 1995 for underwriting guidelines. Mortgage lenders must now use it. The private model becomes a public infrastructure requirement. Future videos on this channel examine how similar standardization decisions shaped outcomes across infrastructure, regulation, and financial markets. Subscribing ensures those analyses reach you directly. The score is now a prerequisite for renting an apartment in many cities. Landlords use it as a screening tool. Housing access becomes dependent on a financial instrument designed for lending. Employers in some sectors begin requesting scores for job screening. The score now affects income potential. Lower income increases credit stress. The constraint compounds across multiple life systems. Consumer advocates propose including rent and utility payments in score calculations. These are consistent financial obligations. The industry resists because changing the model disrupts existing risk calibrations. Recalibrating the model requires retraining risk models across every lender. It requires renegotiating regulatory approvals. The cost of changing the standard now exceeds the cost of maintaining it. The 2008 financial crisis reveals that high scores did not prevent the collapse of mortgage-backed instruments. Risk was systemic, not individual. The score measured borrower behavior, not system fragility. Post-crisis, reform focuses on lender behavior and capital requirements. The scoring model itself is not reform. The same instrument re-enters the rebuilding mortgage market unchanged. A new scoring competitor enters the market in the 2010s with an updated model. Lenders evaluate it but face a switching cost problem. Their internal risk models are all calibrated to the existing score. An estimated 45 million Americans have no credit score. They are not high-risk borrowers. They are simply absent from the data the model was designed to read. Many of the unscored population are recent immigrants, young adults, and persons who use cash-based financial systems. Their financial behavior is real. The model simply has no mechanism to observe it. The Consumer Financial Protection Bureau estimates that credit invisibility cost affected persons billions in higher borrowing costs annually. The cost is distributed, not concentrated. It is hard to aggregate and easy to miss. In 2022, the Federal Housing Finance Agency begins requiring lenders to consider alternative score models alongside the primary score. This is the first mandated structural opening in the system since 1995. The implementation of the new requirement is phased over several years. Lenders must rebuild internal systems to process two score models simultaneously. Full transition is projected to take until 2026. The persons who were excluded during the 30-year period do not automatically recover. Their credit histories remain thin. Entry into the system in the future does not erase the accumulated gap. A scoring model adopted to increase efficiency in 1989 is now embedded in housing, insurance, employment, and infrastructure access. Each expansion happened one sector at a time, each step individually justified. The model's designers built a tool for lenders to assess credit risk. They did not design a universal access credential. The expansion of its use was a downstream decision made by others. The original decision to adopt a standardized credit score was reasonable. It reduced a real inefficiency. The cost came not from the decision itself, but from the scope it acquired over time. The total economic cost of credit invisibility across 30 years includes foregone homeownership, higher lifetime borrowing costs, constrained employment, and intergenerational wealth gaps. No single institution bears this cost. The system continues operating. Scores are generated daily for millions of persons. The machinery runs at full capacity. The structural question of what it measures and who it excludes remains open. A private scoring standard, adopted to solve a processing problem in 1989, now functions as the primary gateway to economic participation for 300 million persons. The gateway remains exactly where it was placed.